And welcome back to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
I'm Brian.
I'm Will.
So today, guys, we're going to cover a lot of topics. Some of this corroborates with one another, and some of it actually conflicts. So we're going to get into this. Off the top, we have new listings take a hit, possibly due to higher rate mortgages. So where are mortgage rates even headed? New home sales grow, even with higher rates. Home sales will be weak in 2024, regardless of soft landing, per Fannie Mae. And the housing sector showing signs of picking back up from Jerome Powell at the Fed. What the heck is going on? We're going to start at the top and talk about new listings taking a hit, possibly due to higher mortgage rates, along with where our mortgage rates headed, guys. So first of all, obviously we are seeing reported that there is a noticeable move lower in listings last week. This is some year-over-year data, but also, purchase applications are down, and I can't help but think this has to do with that psychology versus economics part of people going, okay, I may be able to afford, do I want to?
Yeah, rates are in the mid-sevens.
Yeah, pushing 8. But one of the things, we are going into slowdown season. We're hitting September. We're hitting the end of the year, so that's probably also picking up into the effect of this. But I think, the rates is still just crushing people out of the purchase power, So as we trickled even more up to 8, those who can will, those who can't will, have to wait on the sidelines.
Yeah, absolutely. I actually did a sample here that I want to kind of discuss it with. So if we're talking about the median sales price in San Diego, it went to 903, and we're going to use that. I think it's a little higher, but it went to 903 with an interest rate of current market, which is 7.375 with 20% down, which most of our borrowers are military. It's 100% financing, right? But we're going to use the 20% down. A PITI payment, which is principal, interest, taxes, and insurance. PITI. So when you hear that, that's what it's for. It's about $6,035 a month. Pretty crazy, right? Pretty crazy. And then what I wanted to do was I wanted to see what the average income was in San Diego. So as of May of 2023, the median household in San Diego is $111,000.
Wow.
Right?
Wow.
That equates to $92.50 per month.
Wow.
So usually if you want to determine a debt to income ratio, you're going to go whatever your expenses are. In this case, we're saying like, hey, we have the perfect borrower. They have no car debt, no credit card debt, nothing, right?
Isn't that everybody?
Yeah, that's, of course. I would love that debt, by the way. But so if your payment's $6,035 and you divide that by the $92.50, your debt to income ratio is 65%.
Yeah, that's way beyond the threshold. So
it's just getting people not to afford. Affordability is not there, guys.
Yeah, this goes exactly back to the affordability problem. And this is why, I was going to ask a question of you guys, like how much of this do we chalk up to being pure economics and the numbers, and how much of it is psychology? Because even among the set of people who economically qualify, I think there's a psychological impact that's happening here. We've talked about this on other shows as well, where we look at like new listings aren't coming to the market for homes because people have to then concede that they're going to sell their house, but then immediately have to go to another one.
Yeah.
And maybe they're super hunkered down and comfortable at 3% or 2.5% fixed loan, and they're loving their payment right now.
Yeah. And here's the other thing that we haven't discussed, guys. In California, what's one of the major problems that we're also facing when people are buying their new home? Insurance.
Yeah. Oh, yeah.
That insurance, I used to quote like maybe 75, 85. Now we're going about 125, 150. Or how about I can't even find insurance.
Or not at all. And you have to use the California Fair program. Yeah.
And that's expensive.
Very expensive. One of the things, going back to the point that you made, is even if we say that the $111,000 is their yearly average, but that's gross, right?
Right.
Yes.
So you still have to consider it the net, which is what they're actually bringing home. And now you're telling me that after taxes is not going to be that $100K. You're really looking at it even tougher.
Uncle Sam, he wants some of your money too.
Yeah, a little more narrow.
Uncle Sam.
So how does that even make sense for you to be able to afford if now your net is nowhere near the payment that you're actually on paper making?
Yeah, I mean, it is that upward pressure where, households that are making more than that $111,000 are the ones who are going to step in and be able to get into that median price home. And there's scarcity of inventory below that price. Yeah. oddly enough, even though new listings hitting the market there's less of them, of the houses that are still there's multiple buyers, because now you're talking about a subset of people who can't afford and have the psychology that they're in it for the long run, which we're seeing. Again, it's not a 2-year, 3-year purchase. I'm buying this for 10 or 15 or maybe longer. I'll just refinance later. Later's not going to be 2024 probably, by the way. It might be 26, 7, 28 by the time we actually start having that conversation, but I'll park that for now. I really do. Well, I do have concern because 2 episodes we had talked about how there are greater opportunities in some of these upper high priced economies, high priced communities and neighborhoods, and it is mechanically pricing people out of opportunities, and I think that is going to be a problem. We obviously cannot foretell now what that will be, but that is going to create issues down the road that we don't yet know how to quantify.
Yeah, exactly. Yeah, the affordability hit for home buyers is real, guys. Yeah,
I mean, the chart. One of the charts here I'm looking at from Altos Research is they call it themselves inventory, a slow moving zombie of 2023. And they're citing that there's some seasonality coming into the fall and the winter, which is not as much of a problem here in San Diego. And I think we have that in our favor, but we do not have the economic advantage because there are places where maybe they have unfair weather in the winter, but their prices are not as out of control compared to San Diego's great weather year round. But now we have an economics issue.
Well, the good thing is we save some money at least on the AC. We only run a couple of weeks out of the year,
Yeah, and and these things also go hand in hand, guys, with things that the Fed is looking at as far as like the personal consumption expenditure, inflation, all the forward-looking housing data is honestly waved the flag a little bit. It is the forward-looking data is a little bit weaker and weaker because we are now into territory that we have not been in. Last week we talked about mortgage rates being in 7%. They're the highest since they've been in 23 years ago now. Yeah. Okay, so now what happens when we're here? Yeah. Now that data is being amassed and accumulated now.
Yeah.
We don't have any of that impact yet measured, and we won't for months ahead.
Yeah, data's good.
Yeah, no. One of the things I wanted to say on here on the graph for inventory is as you see in 2023, it starts a lot higher than all the other years. And if you notice towards the end of these of August on both, it starts to either taper off, go up a little, and see the end. But here we're starting to see that it's actually going to go higher before it goes, comes out. Who knows when it's going to come down? But the trajectory right here to me, it seems that the trend's going up.
Yeah, the inventory is coming around, but it's paltry still. It's still a scarcity game.
Yeah,
and it's not an opinion. I'm just saying, like on the graph even that we're talking about, guys. Like the tail of the right end of your graph is the beginning of the left end of the graph.
Yeah.
So you're ending one year and starting the next on that exact month, January 1st, and so it does have this kind of like ripple effect through it, and we're going to see inventory tightening probably going into the colder months, even though they're not necessarily colder here. Yeah. That is going to happen. But the interesting thing about, I think, today's conversation for me, too, is that home prices or home sales of new homes are still going. Like builders are like, oh, hey, we'll come in supply. We'll solve some of this supply issue. And they're coming to the table because I saw some interesting stats here about how they make their determination of whether they should be building or not.
Yeah.
So for this, I feel like builders have the upper hand because they hold, the margin of how much they could actually, let the house go down for, how much they could take a profit up.
Correct.
And it just seems that whenever they need to make it happen, they're like, hey, well, there's $30,000 to buy down your rate, pay down some debt. And I'm sure, Lonesome Mike can chime in on this. Mike, how much did your client for your new build get in credits to be able to, make this loan work?
A whole $35,000, which is
kind of ridiculous. So it just seems like, with the builders, if it makes sense for them, they're like, well, I can lose $30,000, still make enough in my margin. Let us get in. Let's move some houses.
Yeah. So can you repeat that again?
Lonesome Mike.
It was $35,000 in seller credit.
So that's an indication to me of a couple of things. Number one, there's enough margin in that. Number two, it's worth them doing to move a house. And also, it sets a precedent that probably the next buyer can get a deal like that too.
If you guys think about the household income, $111,000.
Sure.
Getting 35. They just gave over 0.25% of annual income in an incentive.
Right.
Guys, where are we at? Where are we going with this? Right.
Yeah.
Yeah, no, I think builders they have, I don't say they have an upper hand, but they get to play their hand.
Yeah, exactly. And some of the things that I wrote here are some of the reasons why home builders do have an upper hand is they have incentives, to provide the credits for the buyers.
Yeah.
You know, they'll do a 3-1 buy down, a 2-1 buy down to buy down the rate. They offer solar, and believe it or not, solar actually saves you money. I have it on my property. It saved me money. When I was summertime, you know, my bill would be like $850, $900. And with solar now, hey, I'm at a whopping $350, $400, right?
Fixed.
Yeah,
Wow.
which is not bad in comparison.
Yeah.
So with these new builders offering those incentives, providing solar or solar options and included into your home purchase, it actually makes some sense because they're going to save money on a monthly bill, you know, by getting solar through the builder.
Yeah.
So, and then they have the closing cost credits, right? Not only do they have that, they have a closing cost credit. And basically, builders can do whatever they need to do in order to make a deal happen. Whereas a homeowner, a lot of times they don't have that.
Well, they won't have that huge margin where it's like the seller needs to make some sort of money back, and the builder's like, well, I could lose $30,000 and still profit enough for me to, you know, make my margins.
Yeah.
Yeah, it's kind of an advantageous position because they really get to determine, they kind of can move the needle towards or away from the incentives to determine where our buyer's at, kind of like where the meeting of the minds, where do we both agree there's a deal for us? The buyer goes, oh, that's a sweet deal. The seller goes, yeah, I'd agree it's a sweet deal too. Let's strike that deal and get it done. Yeah. So I think there's that, you know, the part that struck me here was that most of the active units of supply in scale will have to come from the existing home sales market. So when we talk about inventory, builders are not going to completely solve the problem. Yeah. So we still don't, you know, so although builders are showing up and they're providing some inventory relief, it will certainly not settle the entire problem of inventory because that heavily relies on existing sales too, and that's been pretty low.
And again, Andy, just to prove that point, as a builder, why would I want to try to solve this problem? I'm going to slow it down too.
Right.
Because then I have more market control, right?
Yeah.
Who has the inventory controls the market.
So check this out. One of the analysts for this article had put these numbers out and said when supply is 4.3 months and below, then it's an excellent market for builders. When supply is 4.4 to 6.4 months, it's just okay for builders. And they'll build as long as new sales are growing. And then when supply is over 6.5 months, the builders will pause construction. So it's kind of like a barometer for when we can know or not know that they're going to be bringing homes. And for them, again, it's this advantageous approach to what's profitable, what makes sense for business, despite things we talked about before, increased labor costs, increased supply costs, delays on getting material, all that kind of stuff that's impacted them too.
A barometer or a mafia?
I said barometer on purpose, but I'm glad you said mafia. That's fine.
You know, they're controlling stuff. They can control it, which is great.
So this is what I thought was funny. When builders need to move product, I'm like, okay, I see what we're seeing here. Efficient sellers. Okay, I see.
Yeah. And it's not like necessarily having a corner on the market necessarily, but this is probably I'm going to say it's advantageous because I keep saying that. But here's the other thing that's not in their favor is the cost. Because, again, you're talking about an affordability crunch where economically there maybe is a smaller pool of buyers now than there were maybe 6 months ago, 12 months ago. But also prices are higher. They've recovered a little bit from their dip. But you know, there's still more coming on the horizon, guys. So they talked about there's 1.3 months of supply that are completed and ready for sale. There's 4.3 months of supply of homes that are still under construction, and 1.8 months of supply that haven't yet been started, but there's been permits already pulled for. So just as a combination of that, you have almost about 7.5 months of total new housing coming on board. So that, I think, is going to ultimately help keep prices stable. Yeah.
What do you think about this, Alonso, Mike, since you have a client that's going through a new home build?
Well, to be completely honest, you know, going back to what Andy said about how there's about a supply of almost 7.5 months. You know, I was reading that if it's anywhere above 6.5 months, builders might actually pause construction. So I was thinking, like, inventory. I mean, it can't go lower. I mean, unless people purchase them, but I don't see it going up either, especially if they're already above that threshold. That would, you know, lead us to believe they'd stop construction now.
Yeah.
And there it is, Lonesome Mike.
There you go.
With the right answers.
Nice.
All right, Lonesome Mike.
Okay.
Week 2, Lonesome
Prepared.
Mike. Let's make a pit stop really quick with mortgage rates. We're talking about, new home sales. We're talking about inventory being paltry, but we have to talk about rates. That is our business. That's what we do. I want to spend a couple minutes here, guys. There's a lot to talk about, but I want to try to distill it to a couple main points. But I want to defer to you guys first. What are some of your takeaways from this conversation that Housing Wire put out? Where are mortgage rates headed?
So last week, the 30-year fixed rate was at 7.29% according to Housing Wire, and that's the highest it's been in decades.
Yeah.
Now, a lot of this article, and I got the vibe from it, is 8% is on the loom, and everybody repeated it and said it in their own format or way. And but they did say that as soon as it hits 8%, we could see a retraction, and it tests the ranges between 7 to 8%, and that's more or less what will probably be for the rest of the year, which is I'm pretty confident along what I feel is going to happen as well.
Absolutely.
Yeah.
This is everything's based on the market data, and economists already predicted rates are going to remain high and are possibly going to go higher. Mm-hmm. And that was also reaffirmed by the Fed, the Federal Reserve, and Uncle Powell. I like to say Uncle Powell because then we got Uncle Sam. They always just,
Come and take some more.
Yeah. So he already said that. So rates are going to go increase. They're going to increase, and they already said they're going to put that until they actually level off inflation here. It's going back to that scary story that you shared last week, Brian.
Which one?
The scary one. You forgot the scary story where the Fed's just going to pretty much kill off the
yeah, and that's still the same thing. They got to kill the bad guy and just make sure that he's still dead. And that's similar to what Jerome Powell still said. I didn't remember that. I try to forget scary stories.
Yeah. Your boogeyman hatchet murder killer analogy last week. Yeah.
they're going to figure out how to kill it.
Yeah.
It's not
just
coming
keeps
back.
Coming back. Yeah, keeps coming back to life.
And not until they bring unemployment down, which is something that they mentioned again, that the numbers are still there. People are still having jobs. And until we see more softening in the labor market, or monetary policy is going to remain tight.
Yeah. I think there's a couple things happen. Well, we know there's a couple things happening. I wrote this myself. Psychological market threshold. That's what we're approaching. We're approaching this 8% number. I think they're teasing that number out a little bit to prepare people that we're going to touch and flirt with that. A lot of that has to do with the 10-year yield. I'm not going to go down that rabbit hole and explain all that on the show. That's what we have Monday Mortgage Minute for. Mm-hmm. But this is where we're going to reach a threshold where people are going to go, hold on, we've seen enough. It's too tight. It's been too long. But they're going to have to continue holding, and they're forecasting this. This is their version of letting us know that they are going to have to hold and stay here for a while, and here's why. At the end of 2022, economists forecasted rates would be roughly 5.5% by this point. We are dramatically beyond that. And to return to 5.5 would cause a couple of problems. Number one, that means something else in the economy is broken, and we have to go back to 5.5%. Number two, that means that you're going to have a resurgence of buyers, which then would inflate prices again and put even more problems on the market. And that does not necessarily mean that more existing homes would hit the market because, again, people are still comfortable at 3. So it's like a calamity of issues. And I think they're just part preparing us for this 8% level. But that the scarcity along with this is going to give them a situation where they can hold this pattern for just long enough to give themselves a chance to get back to 2% inflation.
When was the last time we saw these type of rates?
Early 2000s.
Early 2000s. And then I read in the article that it says these types of rates spurred house prices to start coming down. But right now, the biggest obstacle is that there isn't no inventory. So, in a regular market, higher rates do bring home prices down. But they're stating right here that home prices aren't going to be, budging or even going down drastically, but could hold their price or significantly continue to rise, as we're starting to see. And we continue to see.
In a traditional ebb and flow, that is absolutely correct. I mean, but home prices, I don't think are going to come down unless people are unable to afford. But there's just like the resiliency factor that keeps happening where there is affordability among higher upper echelon earners or combined income households and all that, where it's still continuing. So that means that we should assume then that the price stabilization or mild increases will continue as well.
And I love how, other people said, when I first bought my home, when I did, it was 8.75.
Right.
But the purchase price was $242.
That's right.
Right? So I've been in this industry 17 years now. I can't believe I'm giving out my age here, but 17 years to hear a payment of $6,000, like I used earlier, $6,000, what was that? $6,035 with 20% down. Most of my clients that I work with don't have that 20% down. You know, so you're seeing $6,035. That's a lot of money.
Paying yearly salaries.
Yeah.
You know what I mean?
Yeah.
So it's very different. Very different.
I'll tell you right now, I think my patience as a professional is wearing thin with these references to, oh, well, relatively historically speaking, 7 and 8% is still really low.
Yeah.
That's fine, but you have to go all the way back to the early 80s to say that, which now for most people is not true for them. You have to be talking to people in their 60s and 70s who bought their first house 40 years ago where 7 is low to them. So the amount of people that applies to is very low and narrow. And I'm honestly, I'm losing my patience a little bit with that explanation because you're talking about people for the last 15, 20 years that are not used to 7.
No.
Even 5.5, it seemed high for a long time. And we've been in this economy where everyone's used to this low rates, low cost, ease of money, access, affordability. We're getting more people in homes. Percentages of home ownership was going up for a long time, and then it flattened out, and then it's even depleting now.
Yeah.
Like this is an actual problem, and referencing those 40-year time frames is not helpful.
Yeah, I mean, hey, I was experienced when I first bought my home. I was stressing out the payment was going to be, I was with Tanya like, how are we going to do that payment? One way or another, we'll figure it out. I did the dollar menu at Jack in the Box, and hey, I make no money off of that, but but yeah, I stuck to Jack in the Box and the dollar menu at McDonald's, for a while, and then all of a sudden, I was able to make that $2,400 payment. My world adjusted.
Yeah.
So true experience. This is where we're going at. Seeing a $6,000 and change, the average right now I see payments is $5,500 to $6,500 of a mortgage
Sounds
payment.
about right.
Yeah, and we'll see
100%.
who that is sustainable for. We'll see who that is unsustainable for. Yeah, this is a byproduct of obviously a lot of actions, but this is also what is going to this is going to be on the record of the current Fed. They're going to have to be called to account for this because they're even things like these typical concerns we're talking about mean that rate hikes are higher for the Fed's remaining meetings this year because they are not making the progress they want. When you look at PCE going from like the 5s to the 4s and their target is 2, there's lagging effects of policy change that take months to happen. I mean, we've been in a rate hike environment since March of 2022, and this is we're in September now. So now we've gone a year and a half in a continuation upward cycle of rates to now be told, okay, we're going to have to flatline this and hold and be in a holding pattern for a while, and then we'll have to course correct later. We're not talking about month timelines now. We're talking about quarters and years. Yeah.
I mean, here the Fed is they're fighting a balancing act right now.
Oh yeah,
and like I said,
it's like a tightrope. They're walking a tightrope.
At the beginning of the year, everybody thought that people would the Fed would start to cut rates by this time, right? But we're having the different conversation, complete opposite. We're talking about a next rate hike coming up in September once they meet again. So it just goes to show you that the data and the information can be not as, accurate at the time that you hear it, and you have to let the data really come out months over months to really get an idea of how the trajectory of things are going to play out.
Correct. Yeah, combination of a lot of things.
So many.
Essentially, if I was to distill kind of this, where are we going is again straight from the article. If the economic data stays firm, then we're going to be looking at higher rates, maintained rates for longer periods of time.
Yeah.
So I think they're forecasting some behavior, and I think buyers are starting to realize that they are going to have to really confront the reality of the situation and know that it is not going to change overnight.
Yeah.
But then decide, am I in the market now or am I not? And again, talking about our winner's mentality last week, if you're a winner, you're going to win no matter what the market's doing. And I think that is really who's going to come out on top.
That's right.
Kind of like the conversation we're having early, looking at it like a long-term investment. If you have the plan and you have the, the measures to be able to cover that higher payment by house hacking, getting some roommates, maybe your house has an ADU, or, you're able to make money off your property. Yeah. Right now, those properties down the line, 3, 4, 5, 10 years are going to be cash cows or are going to be an investment that you said, dude, I wish I would have made that purchase back in 2023 when everybody was going crazy, but I said I have a long-term commitment to this and I see the way out.
I mean, that's a great point, Brian. We're talking about here around the corner, a 2-bedroom, 2-bath is renting for $3,400 to $3,800.
Yeah.
I'll go get a 3-bedroom that has the potential of me utilizing the ADU rules that we have in California, that we can make the 2-car garage into a junior ADU. Exactly. Rent that thing out and many of my clients are doing it right now. I've actually personally been doing it for my properties. Rent the thing out for like $2,000 to $2,200. Yeah. So that kind of offsets that. And how expensive is it to convert a garage? I mean, you're talking about $55,000 to $75,000.
And then once you bring that payment down, does your payment go up? No, you could actually bring the rents up.
Exactly.
Yeah.
And then now, are you making more money, or is
Correct.
your investment now actually, cash flowing and giving you a better return?
Yeah, and we're talking when we bring them down, when the rates go down
Yeah.
and you refinance, you put yourself in a better situation.
100%.
Absolutely. So, everything is like, people tell me, should I buy now? Listen, it's like the stock market. It's not timing of the market. It's time in the market. And longevity, if you're telling me I'm looking to stay in this property 2-3 years, I say maybe hold off, But if it's long term, which I think anything in San Diego right now, it should be long term, you'll be A-OK. 2 thumbs up.
Well, guys, let's go
What does
to,
what does Lonesome Mike say about that?
Well, you guys cover a lot, so what exactly are you? Do you want to know?
He says, move on to the next subject.
Would you give us?
To be honest, though, when you guys were talking about it, like, it's crazy. Just some of the things you brought up, like for example, Andy brought up how he's frustrated as a professional, referencing these late averages. Because, for example, let's say people in me and Brian's age group. I mean, Brian's a few years older than me, but similar age group. You hear that stuff, and you can't help but kind of look at them like, well, great, but what does it have to do with me? It has nothing to do with me. It's irrelevant.
You're like, I don't even make that much money.
Yeah, well, and the timing element
Yeah,
doesn't
yeah,
make
yeah.
any sense. Like, where were you in 1982? Like, you weren't here, so.
Hold on. I
That's
was
the
trying to
answer.
remember.
Yeah.
I can't, Andy. I wasn't here.
No, but that's
Oh,
that's a good point, Mikey, because there's a
Yeah.
lot of people that are like watching this and they are your age, right? They are in that like early 20s, mid 20s, or maybe even the early 30s, and they're like, yeah, 1982 to 1987 wasn't even like, that's not a thing for me. I read about that stuff in history books.
Yeah, and just to go back to both Will and Brian saying they expect rates to go to 8%, I think the same thing too, but I guess if you really wanted to break it down and ask for like some evidence on it, they were saying if the 10-year bond yield closes above anywhere between 4.34, it could go to 8%, and it just closed right under that recently. So I mean, if you want to, I don't know, do what you want with that information.
And those are levels we've seen around the 2008 financial crisis.
Yeah.
Yep.
So
Same
very,
thing.
very something close to pay attention to.
And
Yeah.
that's why that really tight bond between the 10-year yield and mortgage rates as forecasters of one another is made, and it's been historically like that for a long time.
Okay. So Lonesome Mike already getting it
Yeah.
down. Look, he's the youngest mortgage hero.
That's right.
I like
I
that.
just,
Good information. 2 thumbs up,
I
Mikey.
just
On
need a
that.
new chair.
Yeah.
Hey, relax.
Yeah.
All right,
Squeaky,
moving on.
in the squeaky corner. All right, guys. So last thing today is we need to talk about Fannie Mae and Jerome Powell. And I'm putting these two topics together because, Fannie Mae is coming out saying home sales will be weak in 2024 regardless of, quote, soft landing, which soft landing is a term that Jerome Powell and the Fed have been using for a long time. Even Janet Yellen saying soft landing. And Powell is saying housing sector showing signs of picking back up. So what the heck do we make of this?
So I think unless more houses come on the market because people need to sell because of a distressed financial situation, loss of a job, they got married, they need a bigger household because they're having kids, families expanding, whatever it might be, I feel that's the only thing that's going to, trigger more sellers. Unless rates start to come down a little bit and, give people the opportunity to be able to sell some of their houses so they can get into another house that isn't at a high rate and they have to pay so much for it. I think if those two things happen, then we could see a better real estate market. But unless one or the other happens, then, it's really going to play off whatever that does.
Here's the other thing that we also haven't talked about. We have Airbnb. We have all these short-term rentals now. So I think with the rules and regulations as some states are implementing, like Texas, they're implementing stricter rules on those things. For investors that can't rent it long term and the numbers are making sense, it's time to put that on the market, And what triggered that Airbnb frenzy was 2020.
Yep.
Hey, I can work out of home. I can buy another home elsewhere. Now I can rent it out. Great. But once they start putting those rules and regulations, I think we're going to start seeing a lot of people thinking that they're investors because Airbnb is such a great thing that they're going to probably say, I got to pull out of this. This is a lot of work.
And I think, that'll bring a lot more inventory to
Absolutely.
the market, which will bring prices down. And then hopefully at the same time, the Fed is bringing rates down after, we go into 2024. And hopefully there's no recession in the beginning months. which is something that, was brought up in the article. So I think it's, very case by case. We have to continuously see it, observe it, and just follow the numbers throughout the year to really have an idea, because there's no way of saying this is what's going to happen, that's what's going to happen. As you saw, they said that rates were going to be brought down at the end of the year, but we're over here raising them. So it just goes to show you that a lot can change.
Yeah. And, it really did kind of bum me out to read that. Fannie Mae projecting a modest recession beginning in Q4 of this year or in Q1 of 2024. I mean, all the signs are kind of pointing at that. Of course, we're not supposed to say that on the internet, and you can't define what a recession is in 2023. Okay. But here's the real problem is that things are resilient. Retail sales is resilient, and you have CPI resilient. You have wage growth resilient, and you have GDP still in the positive. So we don't even have the traditional definition of recession yet, which is 2 consecutive quarters of negative GDP. We don't even have that yet. So all signs point to the Fed having to raise higher, which they just did at Jackson Hole. So Jerome Powell saying they're prepared to raise rates and they're prepared to hold it at high levels means that they are not going to waver from that 2% inflation target. And that just means that it will be persistent for longer.
Oh, yeah.
Wonderful.
So, one of the things that came up that I saw that Powell said, he said, according to him, main concern here is rents, which have only begun to slow down. We will continue to watch the market rent data closely for a signal of upside or downside risks to the housing service inflation. So it goes exactly to what you said about the Airbnb. Once, the rents aren't coming in and they're not making their payments, I'd rather not foreclose on a property. If it has equity, you can sell it and still be able to, save your investment, or, walk away without minimal damage.
And usually
with
your
minimal
investment,
damage.
and that's why interest rates are much higher when people purchase investment, because they run that risk that, which house are you going to let go? Your primary or your investment? Hey, I'm not going to pay payment on that one. That's why the banks are more at risk. And so therefore it's going to be a higher interest rate because of it.
Yeah. The thing that I think is going to be really telling is, you're referencing Airbnb inventory coming into the market. I'm wondering if that is just going to absorb the people that are competing and being outbid. Because let's say that there's 10 buyers on a house and there's one offer accepted and those 9 are still looking, but there's 9 Airbnbs come up. All we've done is just equalize the demand and the supply issue. So I'm really kind of surveying in myself and the data, like what does that mean from an inventory and a home price perspective? A couple shows ago, we talked about our wager, our price is going to be higher, lower, or the same. We're going to go back and look at that at the end of the year. But it does make me wonder. And you wonder what investments are people willing to cut ties with and just go, you know what, I'm going to take the L, or I'll take my minimal gain versus the high gain and aspiration I had. Hey, I'll just take the one that I got in front of me right now rather than take the big L later long term.
Oh, yeah.
And again, all indications of what Powell and the Fed are saying is that they are committed to this. They're going to be watching all these market variables. September may be the meeting they raise rates again. If they decide to pause, I think that would be an error, actually. I think they should just do it going into what are traditionally more slower months of lots of things. And I think the new issue is going to be, what do we see out of consumer spending in the winter? Not for this show, but that's what I'm already looking at right now.
I feel people buy the hype and sell the news, meaning that, whenever they come and say this, like, oh, they're going to raise rates. Well, then, hey, they're clearly stating it, not saying it abruptly and saying, hey, this is what we're going to do. But you get the gist of what they're trying to do. And then that lets the markets know, like, in what direction it should be moving. Yeah. So if they're already saying this and signaling and talking in this type of, demeanor, then I feel that rates are only going to continue to go higher because of the fact that they're stating everything is not going the way that they want it to go.
Yeah, absolutely. Do they even know?
And to their point,
the speed is the problem, in my opinion. This
Absolutely.
is heavily opinion. The speed is the problem. Quoted here is PCE peaked at 5.4% in February of 2022 and declined gradually to 4.3 in July 23. That's a difference of 17 months for only a 1.1% change.
What?
So if we're supposed to go from 4.3 to 2, then I'm going to double that 17 months and say that's going to take another 34 months.
Jeez.
That's flirting with 3 years from right now. So this whole idea of, we're going to get to 2%, like that would mean if that happens in the next 12 months, it's not only 2 years sooner than what is forecast at the current speed, but that means something that has not yet happened that's bad is on the horizon, and I do not like having to admit that or feel that way.
That's data.
And Powell straight up saying, despite Powell seeing the current rate of restrictive to the economy, he can't identify a time where basically they're going to be able to bring this down. So they're right there, he's signaling saying, we don't know when it's going to happen. but we're doing stuff.
Yeah, yeah. I know we said it on the show a while ago. I'm like, the Fed's not in control of inflation. Inflation's in control of the Fed. I think that is prevailing and becoming more true now than ever.
Yeah. That's that balance.
You see the data.
Yeah, that's a balancing act, right? I continue to raise interest rates to cool down inflation, and if I raise them too high, I'm going to cause a recession.
You're going to cause a problem. Yep.
You know, and so where do I go? What do I do?
Yep.
I don't. Hey, you see that? I don't know.
So okay, guys, what is
That should have been our
your
thumbnail.
what is your biggest takeaway of the show today, Brian? What's the one thing you're kind of walking out that you were like, oh wow?
Definitely not rates, because we know where those are heading. I think for me, it was really the how home builders can really just push the market. I think that's huge for me, you know. So, and that really gives people the perspective, like, well, I can go get 30,000 credits here instead of, you know, going over here and having to get outbid. Now, I'm not saying that's always the best solution. There's time and place for everything. Maybe there's no new builds in your area. You're going to have to go to the regular market. But I just feel that the margin that home builders are able to, you know, make, I think is pretty alarming.
Yeah. My biggest takeaway is I'm going to go with the Fed. I don't know. It's just so much data going out there that is just, we don't know what we don't know. It seems like we're trying to fix these things, but they're not getting fixed. And you see it right there on the GDP. 17 months. Come on now. I don't know. How are we going to get this thing fixed?
Yeah.
What I do have a takeaway is, you know, Lonesome Mike gave me so I can get big arms like him. So
Nice.
that's my biggest takeaway.
Lonesome Mike, what's your biggest takeaway from today?
Yeah, to be completely honest, I'm going to have to disagree with Brian here. My biggest takeaway was that all the signs are literally pointing to rates are going up. And I know that might be obvious for, you know, people like us, industry professionals. But I mean, if you just take a look at, you know, if you just take a little bit of a deeper dive into the economics going on in the world right now, we could see rates, everything's pointing to rates rising.
I did say rates were going to go higher. That wasn't the biggest surprising thing for me, though.
That's okay. That's
Thanks
okay.
for disagreeing.
I like
my biggest
Lonesome Mike.
takeaway.
I meant to say agree to disagree. Disagree to agree. My biggest takeaway today was the barometer of whether home builders should enter the market or not. I mean, looking at it from a months of supply perspective makes a lot of sense. Like that resonates with me, and I can see if I were in that position, I would probably make similar decisions, whether or not it's advantageous or not advantageous for me to be building homes in certain environments, and whether or not there's demand for it. So that was neat to see it from that perspective. I don't look at things from a new home build perspective, because guess what, guys? We're not builders.
You're not builders.
And I don't think of it that way. So that was kind of cool for me. All right, rapid fire, favorite part of the show.
Favorite part of the show? Let's see when Lonesome Mike disagreed with me.
Okay. All right, rapid fire.
Once again, I got to say Lonesome Mike in his arms. Awesome
Mike.
guy.
Lonesome Mike, favorite part of the show.
Same thing as last week, just being here because I wasn't here before.
Awesome. Favorite part of the show for me, guys, is being able to actually sit around and talk about this information. I know it's not always happy. It's not always fun. It's not all rainbows and sunshine. But I do think that our combined years of experience, as well as crossing multi-generations of input and opinion, is really going to help drive some positive outcomes for people, despite what might be like cloudy skies on the horizon. So thank you guys for, once again, being on the show with me today. Thank you guys for preparing and showing up ready to help educate and inform people. I really appreciate that. Thank you guys, and thank you everyone for who's watching.
Yes.
Remember to subscribe on YouTube, turn on notifications, and you can also follow us on your favorite podcast platform. Remember, turn on immediate download every single time we upload so that you catch every episode right when it posts. Thanks for watching, and we'll see you again next week.
We'll
Bye,
see
guys.
ya.